What's going on, everybody? Happy Tuesday. This is Sean Richard with the Sean Richard Mortgage team. Welcome to another episode of SRT Live. So thrilled to have you with me today. We're going to get to what you just saw here in a little bit, but I'm thrilled to be coming to you with another amazing piece of miraculous mortgage, economic, and real estate news. It's going to be an amazing episode, and we're going to talk a lot about inflation today. And that is a great topic because it is moving in the right direction. Finally, it's happening. We're so excited for that, and we're going to get into that today. But as always, let's start with the week in review. And so we are going to dive right into inflation. Last week was a very important week for inflation. We got two major inflation reports. We got CPI, which is Consumer Price Index, and we got PPI, which is Producer Price Index. CPI, on a month-over-month basis, came in 0.1% below expectations, which were up at 0.3%. Now, this may not sound like a big move or a big change, but anytime inflation cools at a faster pace than market analysts are expecting, this is a major positive for the economy and a very big positive for home buyers and mortgage rates. On a year-over-year basis, inflation at the consumer level came in a full 1% below previous levels. So it came in at 3% versus 4% on the year-over-year basis the month prior. Now, what's also interesting to note is the Fed does like to look at core inflation, which strips out food and energy. The Fed feels that that's too volatile. Core inflation came in at 4.8%, which is definitely well above the Fed's target of 2%. However, that 4.8% was down from the previous reading of 5.3%. So a full 0.5% reduction in core CPI. This was the big deal. And we saw that translate to improved mortgage rates. And I'm going to dive into that here in just a bit. Now, on the producer side, we saw some additional great news. One note that I'll make on the Producer Price Index, and you've heard me say this before, but the Producer Price Index is somewhat of a precursor to the following month's Consumer Price Index. When producers' costs go down, they have the option of how that translates to the consumer side. Same thing when they go up. They may or may not pass all of that reduction in cost on to the consumer. It may allow them to increase their margins, or they may pass that all along to the consumer and ultimately just reduce consumer costs. But it does act as somewhat of a precursor to the following or to the future consumer inflation reports. So on a month-over-month basis, we saw also a 10% decrease down from the expectation of 0.2% rise in inflation month over month. And year over year, we saw a nice big drop down 0.8% from the previous levels down to 0.1%. So previously at 0.9%, dropped all the way to 0.1% on a year over year basis. And this was below 0.3% below expectations. So expectations were up at 0.4%. So many numbers, hard to keep them straight sometimes. But the bottom line is inflation is moving in the right direction, and we beat to the positive side. We came in below expectations, which is exactly where we want to be. Now, we also saw some appealing news out of the University of Michigan with the Consumer Sentiment Index. Consumer sentiment came in at a huge beat versus expectations at a 72.6 versus expectations of 65.5. So it seems that consumers are feeling a little bit rosier about the economy. Maybe we're going to get that soft landing that was only rumored over the last year. So that is great news from an economic standpoint as well. A lot more positivity in the economy about where we're headed than where we have been over the past several months. Now, let's fast forward to what we have this week, starting with today. We got the National Association of Home Builders Index, and we saw just the slightest of tick up from a 55 to a 56 on the index. Not a big move. But remember, anything north of 50 is showing optimism from home builders. Anything south of 50 is pessimism, a less than rosy outlook. One of the big pieces of the inventory puzzle as we move forward is going to be new home builds, because that is going to be where I would say, in my opinion, a large percentage of inventory is going to come from, or a larger percentage than it has made up in the past. Now, later this week, we're going to get existing home sales, and that makes up about 90% of home sales. But I do think that we're going to see the new build sales start to creep up as a percentage, being that that's where I believe that we're going to need to see a lot more inventory come from. So home builders have their work cut out for them. All right. So looking ahead, the rest of this week, tomorrow we do get housing starts and building permits. This is going to give us a pulse on construction and what we can expect from home builds over the course of the year. We really need to be somewhere in the neighborhood of about a run rate of 1.8 million new homes built on an annual basis for us to be able to supply the demand that's needed. We've been under that run rate here lately, but we're going to get some more information tomorrow, give us a little bit more insight to where we stand there. And then on Thursday, as always, we get jobless claims. Jobless claims, we get initial and continuing. So initial being individuals filing for unemployment for the first time, continuing being individuals that are renewing their unemployment benefits. So we get that on Thursday as well. And then, as I mentioned, we get the existing home sales, and that is another big one. That's going to be really important data for our real estate market, just to really understand the pace at which homes are selling. I do expect that to come down a little bit, only because we can't sell what we don't have. So as we continue to have a bottleneck on inventory, that will throttle the sales numbers as well. So we're going to keep an eye on that. All right. So what does it all mean? Well, let's start with inflation. So with inflation coming in below expectations, that mortgage rates were able to gain almost all of the ground that they lost over the past 10 days back. This is great news. We saw the rates climb up into the low to mid sevens, depending on where you're looking and what day. And so we've seen pretty much a complete reversal of that, with the inflation numbers coming in cooler than expected. So fantastic news. If we continue to see inflation decline, not only will that help mortgage rates going forward, but it also could positively impact the Fed's outlook on their rate hikes. The Fed, as we all know, has increased the Fed funds rate by a significant margin over the last 12 to 15 months, and the economy is feeling that. That has caused prices across the board to go up. Costs for businesses have gone up, and a lot of that's been passed on to the consumer. And so as inflation cools, there's a good chance we're going to see the Fed maybe go back to a pause in increasing the Fed funds rate. If you recall, at their most recent meeting, they paused. They elected not to increase the Fed funds rate. The Fed does have a meeting this month, and the expectation is that we are going to see an increase in the Fed funds rate. The amount of that increase could be up in the air. I think anywhere from 1/4 to 0.5% is likely. But with cooling inflation, a great report last week, that could alter what the Fed thinks that they need to do going forward to help get inflation under control. Additional pauses could be beneficial for the economy. So let's keep an eye on that. Speaking of the economy, prices are coming down and consumers are feeling more optimistic. I talked about the consumer sentiment. We're seeing more positive outlooks on the economy, and that could lead to a much softer landing versus basically a minor recession versus a deep recession. And that would benefit the economy as a whole, but there's a lot of pieces to that puzzle that still have to play out before we truly understand what type of recession, if one at all, will exist. And then lastly is our housing market. Affordability continues to be a challenge for home buyers with home prices rising and the elevated interest rate that we've been in for quite some time. So buyers who are braving the current market have been getting rewarded with appreciation. We're starting to see home prices turn back around. They were rising significantly. We saw them kind of flatten out, maybe even dip a smidge, 1%, couple percent tops. But we're starting to see home prices turn back around and head back up. And we're seeing that appreciation data out of the FHFA home price index, out of the Case-Shiller home price index. We're seeing home prices start to turn back around. If you're a real estate agent out in the DFW Metroplex, you're seeing multiple offers happen a lot more often than they did 3-6 months ago, and probably starting to see a little bit of increases to home prices on your end as well. So the borrowers or the buyers that are braving this market, this elevated rate environment, they're being rewarded with starting to build that additional equity from appreciation sooner, and they're also being rewarded by a less competitive market. But I think we all know that that's not going to last horribly much longer or horribly long. That is probably coming to an end, especially as rates start to decline. We are going to see more competition come back into the market. All right, I'm going to leave you with this today. I do have an event coming up on August 16th. It is a webinar. I'm hoping all of you can join. Let me pull this up and share this with you real quick. So I am hosting, this is not the August 16th. I've lied to you, I apologize. So actually, I'm currently in the midst of teaching a real estate boot camp over in downtown Fort Worth at Fair Texas Title. We've already had week 1 of the course. We've got 3 weeks left. So if you are interested, we've got some great content that's coming down the pipe with this. We're going to be talking about lead generation this week. Let's see, week 2, lead generation. We're going to be talking about that this week. So if right now in your business, you don't have the number of buyers or sellers coming in the door, you need to look at new and I guess new ways to generate more leads. We're going to be talking about different lead generation strategies this Thursday. So if you can make it, make sure that you get out to the sign up. I do have a promo code for you, so that way we can get you a discount on this $20 ticket. We've got 3 weeks left. That $20 is for the entire class, all 4 weeks. So with 3 weeks left, you're still getting some significant value. And if you're in the Powerhouse Real Estate Facebook group, I've got that information in there. But if you need to reach out to me, let's see, let me go ahead and do this. I think I can do this for you real quick. Let me throw this out here. All right, let me turn this on for you. All right, you can't really copy paste it, but hopefully you can pause the video afterwards, and then you can type that into your browser and then go sign up for that. But it's going to be an amazing class this week. The following 2 weeks are going to be pretty fantastic as well. So definitely check that out. And I hope to see you at the boot camp that we've got coming up. All right, well, that is all I've got for today. I just want to say thank you so much for joining me. If you're watching in the private Facebook group for Powerhouse Real Estate, thank you so much for being an incredible part of our community. If you're checking me out on our YouTube channel, please make sure you hit that subscribe button so that way you've got up-to-date real estate, economic, and mortgage information in the palm of your hands. For SRT Live, I am Sean with the Sean Richard Mortgage team. Thank you so much for joining me today, and have an incredible rest of your week. Take care.